Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.
What's up, guys? Mr. Fit to Flourish here. Today I wanted to talk strictly about price action, how to read candlestick charts, and how I'm reading the patterns. And how do you know what's going to happen next? We need to be able to read these Japanese candlesticks, understand what they're telling us, and understand how to move forward. So let's share the screen here real quickly. What does a chart look like? This is what a chart looks like if you're trading stocks, options, or stocks in general, and then assets. So this is what a chart looks like. This is a Japanese candlestick chart. All right, let's go on to the next slide real quick here. Boom. So in order to understand how these work, we need to know what the candlesticks are. So number one, there's a bullish candle, which is represented by green. This represents price moving in the upward direction, price going up. And then there's a red candle, represents red, which represents price going down. Okay, so, and that's bearish. Why is it called bullish and bearish? Bulls, the actual animal, attack with their horns going up, and then bears attack by standing up and then clawing down. So if you didn't know, that's why it's called bulls and bears. Like, share, subscribe to this video if you just learned something. All right. Anyways, so how do these candlesticks work? So the middle part is called the body, and then these skinny parts are called the wicks. Okay. Middle parts of the body, this rectangle is called the body, and these little skinny thingies are the wicks. Again, green is buying, red shows selling. So how do we know? Well, these candlesticks measure the distance that price travels within a certain time period. So if you're looking at a chart, you can actually look at a chart and say, I want to see the price measurement in this 5-minute period, in a 10-minute period, in a 15-minute, in a day period, in a week. Okay. So whatever that time period is, once that time period starts, that's the open. On a green candle, that's the open. The flat part, the flat bottom part here is where price starts. That's called the open. And then at the end of that session, let's say it's a 5-minute session. Okay. We open here at the beginning, and then at the end, we close here. Now, during that 5-minute time period, as time is going on, during that time frame, we might have gotten as low as this low part here. Okay, we might have opened here, came down, but price got pushed back up, and then price probably came as high as this part here, and then at the end of this price session, it closed here. Okay, so essentially in the 5-minute time period, we open here and we close here, with extremes that are depicted by these the high here, which is a wick, and the low here, which is another wick. Okay, the skinny parts are wicks. And then for a bearish candle, when price is going down, again, we open at that flat part, but on a red candle, it shows us that at the end of that 5-minute time period, from our open, we actually closed lower than where we opened. So the close would be the bottom flat part, and the open would be the top flat part. And then again, we have a high depicted by a wick here, low depicted by a wick. Okay, so those are pretty much the extremes during that 5-minute period. All right, so keep those things in mind. All right, and then a bullish. So there's trends. Okay, there's trends. There's an uptrend, which is bullish. So that's just price action moving up from left to right on a chart. And again, it's pretty much a collection of candles. Okay, it's a collection of candles, and the majority of those candles, or the biggest moves, are going to be green. Okay, the biggest moves are going to be green, which is driving this pattern upward. And then a trend that is a downtrend is the majority candles going to be red or big red candles. Okay, which is a downtrend. So from left to right, we're going down. Okay, so we're getting lower highs and lower lows, but in an uptrend, we're getting higher highs and higher lows. Right? Very important to understand. And then last but not least, when it comes to price action, we need to understand the difference between trend bars, non-trend bars, and dojis. So trend bars are big bars that contribute to the direction of the trend. They have pretty big bodies, and the non-trend bars are small, really small bars that don't contribute. So let's show a chart to kind of talk about, show what I'm talking about. So if we show this chart right here, you'll see that this is what kind of trend is this? If you don't know about trends, what kind of trend is this from left to right? All right, I'm gonna wait like in Dora the Explorer. What kind of trend is this? And then she just looks at the screen like a dummy. All right, but I'm just kidding. So this is an uptrend, okay? So big green candles. These big green candles are called trend bars, okay? Because they're huge and they contribute to this trend going up. Now, once we get these tiny little bars right here, these stupid little bars right here. These bars are non-trend bars. They don't contribute to the direction of the trend. As you can see, they literally, when they form, price is just going sideways. Okay, those are non-trend bars. So there's trend bars and non-trend. So these are non-trend, non-trend. And then we got some trend bars. Over here. So we got trend bars, one right there. We got another big green bar right there. This is also a trend bar. It's a red bar. It's a big bar. Okay, so it's considered a trend bar, even though the trend didn't continue down. That is still considered a trend bar because it's a big bar. Okay, here's another big green trend bar, and then more little bars. And then what is a doji? A doji is a bar. Okay, a doji is a candlestick in which the wick is greater than the size of the body. So if you look at some of these, like this right here. That wick, that tail is bigger than the body. That's considered a doji. Another doji here, pretty much a doji there. This is a doji here. So a lot of dojis, okay? And dojis are just where there's a whole lot of wick and not a lot of body, okay? Whole lot of wick, not a lot of body. And there's different names for the dojis, but you don't really need to know about the names. Now, the next thing we need to know in terms of price action. So we talked about candlesticks, what they are, uptrends, downtrends, all that good stuff. Wicks, all that good stuff. And dojis. The next thing we need to know is what is it trying to tell us when we're looking at a trend? All right. This is extremely important. This is going to be a pretty short video too. What are we at right now? 6 minutes. All right. So I'm going to keep it short. This is the last part we need to know about trends. When it comes to trends, if we're at a low, okay, and we have bottom side wicks, which just means wicks at the bottom of the bar. So you see these big wicks at the bottom. That means that someone was trying to push the price down. So price was being pushed down, and then all of a sudden, we had buyers stepping in. It's called buyers stepping in, okay? Buyers stepping in. So these bottom side wicks at a low shows buyers stepping in, and is usually a good sign that we're probably going to start ripping up. Okay, even here, you see someone's trying to push the price down, but buyers are stepping in to push price up. Okay, and then once you get towards the top of an uptrend, we start to get topside wicks. And these topside wicks are showing that people are trying to, wicks on top of the candles at these highs. It's showing you that people are trying to push price up, but then sellers are stepping in. Okay, so there's sellers up here. Sellers stepping in. Okay, and usually you'll get some big old topside wicks. Like even here, it's like, oh, we're trying to push price back up. And then it's like, nope, you thought, bruh, you thought. So wicks there, but all of a sudden we're getting a lot of sellers stepping in. Okay, and I like to draw like these lines right here to kind of show like, okay, there's an area right here where price is getting smacked to the downside. And you can see we started selling off there because there's topside wicks. Sellers are stepping in. Okay, so topside wicks will show you sellers stepping in, and then bottom side wicks shows you buyers are stepping in trying to push price back up. Okay, and this is very important when you're looking at like lows. So if you're at a low, pretty much like at a low, you're seeing these bottom side wicks come in, you can kind of guarantee that we're going to get a pretty big move to the upside. All right. There's also one more concept that I wanted to explain here when it comes to price action, and that concept is consolidation and breakouts. I might actually save that for another video. I'll save it for another video. But anyways, that is price action, the generals about price action. So just wanted to kind of share that with you guys so you know, okay, how do you know what's going on a chart? Because most people just look at a chart and it's like they just see green and red. But in order to understand how to read the chart, you need to understand how to read each individual candle, okay, each individual candle, and see what exactly is going on. And then you can get the overall picture of where price is going to go. All right. And this works on pretty much every time frame is literally you read it the same. All right. Big candles, top side wigs, bottom side wigs, little candles. It's all the same. All right. Anyways, it's your boy, Mr. Fit to Flourish. Like, share, subscribe, all that YouTube-y stuff. Let's keep it going. Hope you learned something today. And I'm outie.